Hi and welcome to Swissquote's Daily Market Talk. It's Thursday, March 13th. The tariff war intensifies as the US imposed 25% tariffs on steel and aluminum imports, and the European Union and Canada responded with tariffs on their US imports. On the economic data front, yesterday's CPI data from the US surprised to the downside and certainly somehow countered the negative mood from the tariff battle, but enthusiasm there remains quite vulnerable as uncertainties get worse by the day. So after all the tariff shenanigans between the US and Canada earlier this week, imposing tariffs on each other and rolling them back, I thought that we were flat in terms of tariff news yesterday, but no, I was wrong. The US still went ahead by imposing 25% tariffs on all steel and aluminum imports from everywhere. It is just that the Canadians were imposed at 25% like everyone else and not at 50%. Jeez. So the hell broke loose, obviously, because the Europeans and the Canadians weren't happy at all and they immediately retaliated. The EU announced tariffs on around 26 billion euros worth of American goods imported to the European Union, while Canadians said that they will impose tariffs on 30 billion Canadian dollars worth of US products as soon as today. So voila, happy Thursday, everyone. Let's see who blinks first. Now, happily though, we had some good news on the wire in terms of economic data yesterday to balance it off. The US inflation is more than expected in February on both monthly and annual basis. The prices of new cars and gas had a good easing impact on overall price pressures last month, while egg prices soared more than 10%. But apparently, the slowing demand there could eventually help the producers catch up their breath with the bird flu and balance out the recent rise. So the market modestly cheered the latest news. The S&P 500 recovered some 0.49% yesterday. Nasdaq 100 rebounded more than 1%, while the Dow Jones Industrial Index still retreated 0.20%. The volatility eased, but the worries remain, obviously. They remain as the tariffs will have implications. In the first place, they will cause a few jumps in price levels. That's a mathematical certainty. You could argue that the price jumps due to tariffs will probably be limited in time. They're going to be a one-off jump, but bringing production size back to the US, for example, will certainly have a longer-term impact on goods prices that are made in America, because obviously it is cheaper when the things are made or at least partly made in China or Mexico or Vietnam or so. Then, the tariffs mean the end of a free trade era for the global economy that helped global economies, and sorry for being too honest, but especially help the rich Western nations, including the United States and the European Union and the United Kingdom, to benefit from the so-called invisible hand, make the best do the job, which concentrated high value added, well-paid jobs in the West and pushed the low value added, low-paid jobs to the others. And now that is kind of out of the window. It's certainly politically an excellent thing to do for Donald Trump to give Americans some work, but in terms of amassing wealth in the long run, it is questionable. Anyway, today, investors will keep their focus on US producer price inflation, where the headline PPI figure is also expected to have benefited from the latest weakening in energy prices and could print a softer number compared to a month ago. But the soft numbers are cheered with modest enthusiasm from investors again, as the tariffs and their broad implications are unknown at this point in time, because no one really knows how long they will stay and how far the retaliations go, because Donald Trump already said that he will retaliate to the European Union, who dare to respond to his tariffs on metals by imposing tariffs on their own. So if we're lucky, the softer than expected inflation figures of this week from the US could maybe help taming the inflationary expectations for the US, which have risen significantly due to the tariff walkdown. But I still believe that the outlook for the US indices remains comfortably negative right now because, funny enough, yesterday's softer than expected CPI prints didn't really increase the probability of a May interest rate cut from the Federal Reserve. On the contrary, the chances of a May interest rate cut from the Fed implied by activity on Fed funds futures fell to around 30% this morning from around 40% where it stood yesterday morning just before the release of the latest CPI data from the US. And add to the mix that the US Democrats and Republicans are having quite hard time these days for agreeing on a spending bill for the US, increasing the chances of a US government shutdown. Well, one should really look carefully to find a good spot, a good place to hide in the US equity space. Now, across the Atlantic Ocean, mood is a bit different. The Stoxx 600 index jumped off its 50-day moving average level yesterday, and that despite the tariff ping pong that is going on. The euro's appreciation against the US dollar obviously helps to tame inflation expectations here in Europe, and along with the prospects of high spending on defense and security, that actually boosts these expectations. So it's just like balancing out, and the whole thing is boosting growth expectations, and gains here are certainly on a more solid footage than the US peers. Now, the euro dollar tested the levels above the 109 level this week, but given the overbought market conditions of the moment, well, approaching a psychological level like 110 is not really easy. So that level may not be cleared so easily, at least in the short run. Now, I believe that the euro should first take a breather, maybe see a minor price pullback, catch its breath, and then jump above that 110 psychological level. Now, support to the positive trend building since mid-January is seen near the 107.30, 107.70 level, including the minor 23.6% Fibonacci retracement and the 200-day moving average. So, price pullbacks toward these levels could be interesting opportunities to strengthen the long euro-dollar positions. Across the channel, well, the Brits are a bit lost, to say the least. They, well, actually want to ink a trade agreement with the US and make the Brexit, which has been so painful for the UK economy and also the pound, well, worth something better than what it was over the past 9 years. But so far, well, the Brits have only been the collateral damage of the global trade war, and they are also left out of the ample spending plans from the European Union. So they are now having the worst of both worlds. So cable is testing the 130 offers to the upside this week, and given the broad-based US dollar depreciation, we could eventually see cable will break the back of these 130 offers. But the pound may have to say goodbye to its advance against the euro, the single currency, as the growth prospects are turning shinier for Europe than for the UK. The pair is now testing the upper band of a 1-year downtrending channel, and a potential rise above the 0.85 level will confirm a medium-term bullish reversal in the euro pound in favor of the single currency. The UK will release its latest GDP figures tomorrow morning, and the figures are expected to show a slowdown in growth in February to just around 0.1%. In the equity space of the United Kingdom, while the FTSE 100 index also benefited from the rotation trade from the United States toward the old continent, toward the European indices, but the index underperformed the Stoxx 600 lately, a gap that could be attributed to this extra military and security spending budget that the European Union benefits from that the UK does not for now. So it's mining stocks, the mining stocks in the FTSE 100 weren't necessarily hit so far by the tariff threats, as the threats actually increased demand from companies who were looking to front load their metal and commodity purchases before the tariffs went live. So Rio Tinto, for example, remained quite range bound in the first 2 months of this new year, as we saw the copper futures rise more than 20% since the beginning of the year, and that despite the waning global growth prospects that copper is generally impacted by. But that rally now looks vulnerable because the tariffs are on. And even though copper is not yet subject to tariffs, well, the US is thinking about including copper into the mix. And it means that the impact of the latest tariffs should hit appetite in the minor heavy FTSE 100 worse than the continental European peers. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive messages. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below. Follow us on Instagram, on X, and on LinkedIn, and also on our new WhatsApp channel, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.